Hello traders, Nick Shaheen here, looking at trying to explain in plain simple English bonds and how they sometimes are inversely correlated to the stocks. I know some technicians out there or mathematicians will come out and say there's no provable correlation between whatever. I know what I see, and let me see if I can explain it here. So the SPX is having another bad day, down whatever 6-8%. Small caps down 11 or 12%, and bonds are ripping. But I think today bonds are ripping because of the Fed rate cut. So why does this is the SPX, we're looking at it. It's fulfilling a technical breakdown that happened on a weekly chart. I think we can show it. This inverse head and shoulder type of a deal. So it's overshot already. But back to what happened. So the Federal Reserve controls the overnight lending rate and other monetary stuff that they can do in order to either crimp money flow or making money available to the people that actually move it throughout. It's not like fiscal spending where the government says, I'm going to build bridges, to use the typical thing. So the Federal Reserve can do that, manipulate the rates, buy stuff. When it's buying stuff, it means it's putting money out, and whoever's selling that is taking that money, and the assumption is that they take the money and do stuff with it, right? So that's called QE. QT, quantitative tightening, is when they were doing and they stopped, which is lightening their balance sheet, selling stuff. So after 2008, they started buying whatever, 50, 60 billion a month. Then they said, we stopped buying the taper. Remember that? That caused a taper tantrum. They stopped buying, but now they have a huge balance sheet. And then they started selling it off. That was QT, but nobody was talking about it. And then they decided, you know what? We're not going to do that anymore. And I think they went back to buying something. Anyway, the don't call it QE thing. But the point is, they can do stuff like that. And last night they cut rates. So when they cut rates, the idea is that yields fall. Bond yields fall. So the TNX is the 10-year yield. You know that when the yield curve is inverted, that's one of them. That's the 10-year, and they divided by the 2-year. So the yields fall. So now they're down 23%. This is huge for one day, but it's way off the low. The other day it fell to 40 cents. So when yields fall, the opposite of yields is the price of that bond. So most people look at the TLT. They call it bonds, which is really the 20-year price of the bond here. So it rises when the yields fall. If you think about it, if I'm selling a widget and the widget is selling like hotcakes, meaning the price is rising in the widget, I don't need to provide a sale for it, so I don't need to give you an incentive, so I'll just drop the rate. So there's kind of an idiot way of thinking it, but that's how they go, always in the opposite direction. The price of the bond itself and the yield it provides. So when the rate cut comes out, it only makes sense that the yields fall and the TLT rises, the bond rises. So, but there's also something else going on here. Usually the bonds, the TLT ETF, it trades about the same as the futures contract, which, like ZB_F or whatever. But these days, it's almost like double. It's like this is working like a leverage ETF on crack. Like today it's up 4 or 5%, which is insane. But if I look at the contract, it's like 2.5%. That shouldn't be, at least not when somebody I know brought it to my attention. I didn't pay attention to it. But technically, this is a cup and handle, and this is the target of it. So it's not surprising that this happened, technically speaking. But the rate cut kind of like messes things up. The dollar weakens. So all kinds of stuff happened because of the action that they took overnight. So on a day like today, I don't think of the TLT as a flight to safety, although markets are down so hard. It just so happens that it's the motion that should happen on a rate cut, a blow up in the TLT and a collapse in the TNX, which, by the way, you remember the tizzy we had from the yield curve inversion? The yield curve was inverted. One day CNBC came out and freaked everybody out. That was right here. This is the yield curve inversion now. Nobody's talking about that. I don't know what that means. It just means that markets are working the way they should be. The longer the commitment, the higher the rate should be, right? So this is, what is that? What's the opposite of inverted? Blow-verted? There we go. I don't know. But this is the plain, simple English way to explain this bullcrap that's going on in the market right now. The Federal Reserve is the only entity going out there trying to do stuff, and I wish they wouldn't, because they can't do anything about it. they should say stuff like, we will provide liquidity. Sorry about that. The chat room is open. By the way, there's a link down below if you want to participate. So, plain simple English, rate cut, bonds should explode, bond yields should collapse, and that's what we're having today. Usually those are inversely related stocks. When bonds rally, stocks fall because it's an either or type of a situation. I mean, for the longest time, how are you in bonds? Well, I'm not buying bonds, I'm buying stocks. So it's like the same bucket of money competing for one bid or another. Anyway, that's the simple way of looking at it. Nick signing out.